Good morning, everybody. Welcome back to the Everyday Growth Advisors live stream. It's a Wednesday. Happy hump day, everybody. Hope you're having a great morning with your coffee and bagel or whiskey and Coke if you want to live life on the dangerous edge. Well, what a crazy week, right? I think what a crazy 1 to 2 weeks actually. This is what the 1, 2, 3, 4, 5, 6, 7, 8, 9, almost 10 sessions of higher highs on the S&P 500. Market's been on a melt up. This was definitely expected. We've been covering this move on the live stream for a while now. We did speak about March being a rather turbulent month, and then now a rip up in April leading into May. I would say we still have a good 2 weeks worth of bullish price action. Early morning numbers coming in from banks today. Really great performance from Jpmorgan and Goldman Sachs to kick things off. I think that's setting off a pretty good stance for earnings season. Remember that banks are the ones that set the stage for the rest of the earnings season. If banks do well, typically, then you know that big tech is about to do well. You know that the majority of the market leaders will do well, since banks are the liquidity of the entire system. So we have Goldman Sachs first quarter EPS at $18.60. Net revenues of $17.7 billion versus estimates of $12.55. Goldman Sachs killing the revenue estimates. But remember, the reason why the stock is not up as much is because majority of it has been already priced in, right? That's why Goldman Sachs was rallying these past few weeks, and this earnings report has more than likely been priced in at this point. The trading revenue was $7.58 billion versus a $5.35 billion estimate. And then on top of that, they had sales of $3.89 versus $2.92 billion. And they repurchased about $2.7 billion worth of shares during the quarter. Remember that banks are not allowed to buy back their shares. This was lifted last quarter after the Fed calmed markets with abundance of liquidity. So This is something that you should be looking at right now. And then also remember that Goldman and Jpmorgan, they were able to unlock most of their reserves for bad loans during the pandemic crisis, and they used those stockpile dollars to also propel their lending and trading activity, which is the reason why they did so well. So now that they have already performed the way that they have, now we can probably see a little bit of the coming down of the financial sector. I would say this earnings that got priced in is now fully priced in. And so, in fact, I may not be surprised to see financials correct downward within the next 2 to 3 weeks, or the entire market calm downward, because the market's rallying on the pretense that we will see better performance overall during this earnings period. That's what this rally has been about. It's been pricing in a lot of different things, right? Reopening, earnings, a whole bunch of different things, right? And so I wouldn't be surprised if we see a little bit of a corrective wave down before another impulsive wave to the upside, okay? And then Jpmorgan with a similar beat. Let's see here. I'm trying to pull it up. I'm gonna try and see what was the Jpmorgan earnings. Where you go? Just very quickly here. Net income of 14 billion and then EPS of $4.50. Managed revenue of 33 billion, expense of this much, managed overheads, loans, capital okay, common dividend, $4.3 billion common stock net purchase in Q1 of 2021. So they went double of what Goldman did. And net income at $13.3 billion. Very, very nice quarter beat there. Let's see, card, consumer, okay, wholesale, firm-wide, okay. And okay, they issued $1.5 billion of preferred stock, but then they bought back $7.4 billion, so net, not too bad. Net income, okay, revenues, expenses down. Net revenues are down 6% year over year. Expenses are down. Okay, so Jpmorgan, not such a crazy beat, but still, net income is up. That's a good thing. I'll have to dig a little more deeper into this to see what are the sector-wide performance in terms of the banking sector. But this is a good start. It's a good start. And we'll be able to see if they beat estimates or not. Okay, great. And let's have a look at the news real quick. So, okay. Bill Huang, wipeout ripples, lucrative hedge fund. Bitcoin approaching 65,000 as Coinbase listing. I don't really see what is the correlation there. It's kind of weird, but I don't really see the correlation there. Jpmorgan Asia Pacific Vice Chair retires. Pigs are seen as next big thing as cotton dims. Make or break call, inflation stumps global investors. Why impact long COVID could outlast Macau moves a step closer to digital currency. Where can you fly? Okay. And then I think Chinese stocks were doing a little better this morning. Let's have a look at KWeb real quick. Yeah, just a tad bit. KWeb's up about 1%, which is okay. We saw a little bit of buying yesterday through the session. That was something that we were keeping tabs off. I bought some long dated KWeb leaps, I think day before yesterday. And so here is a summary of Jpmorgan profits. So they had 450 EPS versus the 310 analyst forecast, and a quarterly profit of about 2.87 billion, which is great. And they were able to unlock more majority of the reserves, which is good. Goldman with the same thing. Strong deal making and trading desk, contributing a lot to the top and bottom line there. Let's see, stock futures tick up. S&P 500 hits record. Yep. We had a very insane session yesterday. For those of you that follow us on Instagram, I put out a chart in Tesla, which was beautiful, and Datadog as well. Not sure if you guys are aware of it. Tesla is it went up to cover this gap pre-market here at 782. It could make a big move up to the 900s if it really wants to, but I don't know if it will go all the way by this, this wave. I'm not really sure if it will. So yesterday we played majority of this wave on the Discord. It was great. Majority of us made money on this one. And yeah, that was a good trade yesterday. I'm in also some Shopify calls. I have the 1250s, which is now in the money. This is one that I was trading yesterday. I have some 1250 calls, and then I also bought some Apple calls yesterday to play a run up for the Apple event. I see Apple going up to the 140s more than likely. This 137s is going to be the first booby trap area, and then 140 is the next booby trap area. So this is the two targets on Apple right now. We had the corrective wave here. We may continue upside here with Apple if we can find momentum, continue to press on here. So we'll see if that continues on. What else? Amazon as well, but Amazon's hitting a key area of resistance here. If it breaks out, it's going to go and test all-time high at the 3550 levels. We might need a little bit of a pullback before we get there on Amazon with the bullish pennant breakout. And then DDOG with the same thing. Bullish pennant breakout, which we had yesterday. And looking to go and retest the $100 level is somewhere around here. If we can get a decent pullback. Another opportunity, oil and gas, BP, trading in a nice little uptrend channel and sitting on the bottom channel right here. You might be able to get in before the next wave up. I have some $15 leaps on this one. They only cost about $1,000. I think it's a good prospect if you want to go look at this opportunity. Looks like a great little way for oil and gas to move up here. Okay, so lots of opportunities. Let's have a look at, oops, what else is here? Okay, Grab and then Coinbase. Today Coinbase is going to be listed at reference listing price of $250, putting this at a $65 billion valuation. Personally, I think that's completely whack, and I wouldn't recommend playing the IPO. It's one of those things that, in my opinion, just doesn't make sense right now. Remember, IPOs are not exactly the best way for traders like you and me to take piece of the pie. I typically don't trade IPOs because they're mainly for insiders to make money, not for us. So I would stay away from this IPO, even though it's very, very hotly expected to do good and yada yada. Okay. Pre-market movers, Tesla up 2.7%, Jpmorgan down 0.7%, Morgan Stanley also up 1.46%, as well as Goldman Sachs. So banks with a nice little beat. Energy is also leading the way here. If we can get a nice bounce in energy, we may see continued run. The S&P 500 now on its melt up phase, and I think the 4168 level, 4167 might be a key level for a potential resistance here. This might be a potential level for a pullback. So we'll see if that actually happens. This is the level I'm looking at, and so we're entering that level very soon, where we will get a mini pullback before running up again. It's pretty nominal. Apart from that, everything's looking okay so far. Interest rate jitters are starting to come down. The 10-year yield is now at 1.63. But remember, I did mention the 10-year yield could further go up to about the 2.0 level. The 1.8 and the 1.9 is pretty nominal level, but we should be getting up to the 2.0 levels, sometime within the next 3 to 6 months. That should be pretty nominal as infrastructure spend continues. We see more quantitative easing, and interest rates artificially kept low. Bonds are going to continue to struggle here, especially the shorter term yields, and then the longer term still continue to have good support from the Fed banking system. Also, I believe yesterday we had news that the Fed is going to continue to pump to the tune of $80 billion into the repo markets, which is a good thing, keeping the liquidity fresh and alive. In terms of insider buying, let's have a look here. Moderna, okay. Target executive officer sold 13%. All right, and then we have Estee Lauder, EVP and CFO sold 42% of their share, $6 million. Okay, not too bad. And Stryker, what is this? Moderna, we saw this the other day. Okay, nothing really crazy and new here, but we'll continue to watch these insider sells here on the top 500 businesses. Treasury yields coming down. We'll hope that that continues, and S&P 500 dividend yields about the same as last month, but kind of deproving. I think we may see the S&P 500 dividend yields get better this quarter. Q2 tends to be a better performance throughout the market conditions anyway. Okay, another thing that I want to point out is the Shiller PE ratio and the S&P 500 PE ratio, which are now at the S&P 500 PE ratio is now at 42.17. I know, this is not exactly the best way to judge if market's expensive, because it's all relative in terms of historical values. But just to give you a sense of things, right? The median S&P 500 P ratio, the mean S&P 500 P ratio is about 14 to 15. So at 42, we are slightly overbought in this market. It just means that you shouldn't be putting money into, or you shouldn't be putting majority of your money into this right now. I think you should take this time to actually pick up only businesses that are undervalued, which have great economic moats, good balance sheets, strong cash flows. Those are the ones that will continue to run and hold the market up in this environment. The last thing you want to do is get caught holding the bag on things that are speculative. Even though part of my portfolio consists of some speculation, it's a very, very small part of my portfolio. Things like Palantir, right? Palantir is somewhat speculative, right? I may choose to sell calls against Palantir today on this strength here, because I own 100 shares and I want to sell calls against. CCIV, another one. We haven't been talking about this for a while, but this one also is one of the ones that you at this point, if you want to add positions, I would say wait for a sustained rally for a little bit before you add some positions here, because money is not flowing into these SPACs and these speculative growth stocks just yet. That's going to take a full cycle of speculation, and right now we're in the, we just had a corrective wave down in March, and so it's going to take a couple of months for us to build it back up. I would say sometime again in June, July, August is when you'll see money flow back into speculative investments, and the cycle will continue, right? That's about the same time when I see, the super cycle on Bitcoin start to calm down as well, right? Shiller PE ratio is a little different from the regular S&P 500 PE ratio. This it adjusts the PE ratio on inflation from the previous 10 years. So it's a more seasonally and cyclically adjusted PE ratio. We call this the CAPE ratio, cyclically adjusted price to earnings ratio, which is the Shiller PE ratio. Shiller, I don't know if you guys have heard of Robert Shiller, one of my favorite people to follow in the world of economics. He's great, and I will eventually I want to do my PhD under him as well. So yeah, this is something that you should be taking note of. Okay, great. All things considered, in terms of case Shiller P ratio, you can see we hit an all-time high at 45. We're now at 37. So when we look at adjusted P ratio here, you know, we're at pretty high levels. But I think, you know, this could go higher. We can still go higher. We can still push higher before we get a burst of the bubble. Okay. I just wanted to put that out there for you guys to keep that at the back of your head. It's always a good reminder of where things are when you are dealing with these markets. Okay, do we have any questions today? All 29 of you, thank you very much for attending. Make sure you smash the like button. Thank you for being here. Let's go. Good morning. What's up? What's up? Nathan, Shoei, Mark. What's up, man? What's up, Toby? And FunFit Family. What do you think of Plug? Okay. Let's have a look real quick. This thing's been selling like hotcakes. Yeah, looks like it's at a key level of a dual zone right here. This looks like a key level right here. I think it's possibly a good time to pick up some starter positions. Sitting below the oh well, I could, yeah, that's a good spot to pick up a starter position. This is bar the fact that you believe in the business and you think it's a good business. I do not know anything about this business, but it does look like it possibly wants to bottom out here. Do you think Intel has a lot more room to move down? Let's have a look. Intel's actually on a bullish trend. Intel is still bullish here, not yet bearish. I don't know. I think this is looking more bullish than bearish right now. But would I take it to the upside? Probably not. This is one of the ones that like I wouldn't want to trade just yet. I would want us to make a move either below this significant level here, which is the $60.87, or I want to see it break this all-time high over here at 69 and move to the upside. I wouldn't trade Intel right here. It's just a weird price to trade it at. It could get rejected or it could go further up. So either way, you make a decision here. The risk to reward ratio favors the downside, but just purely out of the resistance that's right here. But I think holding off trading this is a better idea. Teladoc 200 calls. Yeah, I'm looking at. I was trading Teladoc yesterday. Made a quick profit on this one yesterday. This was a good one to trade. Falling wedge pattern. Broken out of a falling wedge pattern on Teladoc here. Looking great for the upside. I think $200 from May is great. Yep, I would definitely take that. Looks like a good trade. If we can break above the 192, 193, that should be nice to the upside at 200, easy. Only thing about this one is like moves kind of slowly. So yeah, I like it. All right, let's cover Sunrun real quick. So we're seeing continued consolidation here on Sunrun in this demand zone. I don't know if it's building a launch pad or it's consolidating to move further down. We do have an upside target of $70 here in the long run, maybe 6 to 8 months, 6 months or so, I would say. And I think personally, this one is building a nice little launch pad, right? And so I would keep my eyes on this one. In terms of technicals, we don't see the buy signal just yet. Once we see the two-wave confirmation on the 15-minute chart, we can actually go ahead and start purchasing this. But as of right now, I don't see the drive to buy this just yet. It could possibly come down to the 47s and try and test this, this region on this channel right here. It has been touching this region and respecting it. So maybe it comes back down here to the 47s before moving the wave up. Now, in terms of intrinsic valuation, this was a rather tough one to do. This business, we can only value it using revenues. We can't use cash flows. Reason being because this business has pretty inconsistent cash flows. So revenues would be a more subjective way to value this business. It's also a utility business, or you could consider it a utility business that's very tech integrated. So I went with the 5-year DCF model with the revenue exit multiple, taking its revenues growing at an increasing rate for the next 5 years, and I took a 5-year model here. The 10-year model was a bit wonky. I tried doing both, but it was a little wonky, so I didn't want to take the 10-year model. With the 5-year model, the projection of revenue was growing slowly at first, and then with the utility business, we want to ramp up the revenue growth. We don't want to ramp down like a traditional style business. Utility style businesses are more prone to stability rather than instability of revenues. Therefore, we want an upward sloping revenue curve with a more concentration on a consistent revenue growth over time. As their networks get more mature, they pick up more traction, that will allow them to grow revenue at a quicker pace. So within the 5 years, we have a 25, 30%, 35%, 40%, and then the 40% constant there, possibly until it matures. Also, remember, I put these like this, but it could easily be the other way, where it's 40%, 35, and then 30, 25, and then 25, same thing. Capex at about, so here's where this business differs from majority of usual businesses. If you're trying to look at the model for Capex here, by the way, this model is wonky on Finbox, so I have to make my own assumptions here. And looking at Capex here, we want to see obviously that the next few years they're going to be spending a lot of money on infrastructure. So 50% or 40% of Capex, a percentage of revenues, and then 10% flat after that as they start to wind down their spending. With the net working capital at about 2%, depreciation and amortization flat between 23% or so, tax rate 15%. Company's not making money yet, so we say tax rate's pretty low. Well, they don't pay tax, they're making a loss. And a discount rate between 9 to 10% seems fair for this kind of a business. That gives us terminal value of about 5.3 to 5.9x. And this is giving us a fair valuation of $43.31 on Sunrun, okay, based on a revenue projection, okay. So 43.31. Like that, and we'll put text box right here. $43.31. Great. And we'll make this yellow and a little smaller. And we'll lock this in right here. Okay, great. So we know our valuation of this business now. It's about $43. So it's slightly overvalued. And I think it's going to get overvalued over time, which is something that you have to keep track of. So you now know the valuation of Sunrun. This is something where we may see continued suppression after this huge run-up. As a long-term investment arc, versus SPY. No, definitely you want to go with SPY as a long-term investment. ARK might be too volatile. The ARK fund is a high risk fund, in my opinion. This is not something you want to. This is not something you want to put your retirements in. This is something you want to allocate part of your retirement account in. You don't want this to be the main event. You want this to be like a side dish in the main event. So I would say, and if you are going to buy a index fund, you got to go for VOO, Vanguard ETF. This is the cheapest one. The expense ratios matter because expenses compound as much as the growth rate compounds. Of course, if you talk about risk to reward ratio, ARK has a better risk to reward ratio, but I don't think that's what you should be taking account when you're looking at long-term returns. Okay, Chewy, yes, this is another one. Thanks for bringing it up, Kyle. Guys, keep your eyes peeled on Chewy here. Really good setup, in my opinion. Looking like it wants to run. The problem is we had an exuberant candle here after earnings. This company smashed earnings, by the way. Did really well. And then got suppressed due to the corrective wave down on the market. And now we're looking at this as a potential upside recovery to the $100. I would say, you know, a longer dated call on this $90 call for May 21st. That's great. That's a great option, I would say. That's a good one. A month out. Yep. Really good. Yeah, that seems like a great play. But what I want to see first with Chewy here, and I think you should also take the same approach here, is a breakout of this resistance. Right? We want to break out of the resistance first, and then a retest of the resistance as a support. So this resistance becomes support now, and then we can play this to the upside. Okay? So I want the trend validation, price action validation here before we take this to the upside. So I'll be watching this closely. I'm going to set a little bit of a alert right here. And I want it to cross, yes, crossing. This is good. Yeah. Okay, great. Well, that's all I have for you guys today. I appreciate you guys tuning into the stream. Thank you very much. If you have any comments, you have any questions, post it in the comments of this video, guys. I love to hear from you guys. So make sure you post your questions in the video, and I'll reply back to them. In the meantime, remember, we do have the beginners course running next week. So if you're wanting to sign up for that course, please go over to our website and do so. Seats are running out pretty quick. And so is the bundle. The bundle is going to be only valid to this weekend by Sunday. Okay, so take advantage of the pricing right now. You get 20% off everything, plus a month's Discord access. I think it's a great deal, and we'll see you there if we see you there. In the meantime, we will see you on Friday for our end of the week live stream, and I hope you guys have a great trading day. Keep it light, keep it tight. And watch the market for a possible rug pull. It's highly possible. We had one yesterday. I expect another one today. If you remember, this week's also OPEX. So don't go crazy on risk. All right. Allocate fixed risk and take it that way. All right. Great. Have a great day, guys, and I'll see you all on Friday. Bye, and I love you all.